Hello, and thanks for watching the video. I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. In this short video, I'm going to give you a brief update on our Q1 2024 figures. The key highlights in a nutshell of our Q1 figures have been the following, and I'm going to add some more color later on. First, with 49 million euros of AFFO in Q1, we are well on track for our AFFO target of 180 to 200 million euros. Secondly, the market dynamics continue in our favor. So the free finance part of our portfolio saw strong like-for-like rent increases of 4.1%. Thirdly, we were able to benefit from first signs of recovery in the transaction market. Overall, we had roughly 200 million euros of disposals year to date. And fourthly, we expect that the devaluation cycle to come to an end, and we expect another -1% to -3% for H1 2024. And we expect then a bottoming out of the market. Let me now walk you through those highlights and add some more color. So, as I said, we are well on track for our 2024 AFFO target of 180 to 200 million euros. This represents a 5% increase over the 2023 result, taking the midpoint of this range into account. Our strong set of financials in Q1 are reflected by an operating cash flow, which is up over 7%. However, it is not yet visible in our key KPI, the AFFO. While on a reported level, the AFFO is down by 11.5% to around 49 million euros. The comparison to the Q1 number of 2023 is distorted by two effects. First, there is, as explained in detail already last year, there was a one-off contribution from our biomass plant in 2023, and this is not going to repeat in 2024. As a reminder, we were able to sell electricity from our biomass plant at the peak 2023 prices. And with this, we generated a one-off contribution of overall 21 million in 2023. And this is fortunately not going to repeat in 2024, which is why it is a headwind for this year. So last year, we had a special effect of 7 million euros from this biomass plant, and this is one of the headwinds. Additionally, we have steered our investments now differently in 2024. And we are striving now for a more even distribution within the year. In the past, we had a gearing towards Q3 and Q4, which drove a better Q1 and Q2 in AFFO terms. And this increased investment spending is a negative headwind of 3 million. However, and let me repeat it, with 49 million of AFFO in Q1, we are well on track for our guidance range of 180 to 200 million euros. Then secondly, on the market dynamics, the market dynamics continue to develop in our favor, as I said. The supply-demand imbalance persists, and we see the latest rent table publications, like in Düsseldorf, for example, or in Bielefeld, to show rent increases of around 7%. Accordingly, our free finance part of the portfolio saw a strong like-for-like rent increase of 4.1% on a portfolio level. At the same time, the vacancy has been further reduced down to 2.5%, and this is down by another 30 basis points. So structurally, we are fully rent out. And then thirdly, on the disposals. We were able to benefit from first signs of recovery of the transaction market. Overall, we saw roughly 210 million of disposals year to date, while we realized a transfer of ownership on sales worth of 40 million euros until the end of March. Those are already factored in within our Q1 numbers. We signed another new sales contracts for another volume of 170 million euros in 2024 so far. On one hand, we sold units at the low end of our quality spectrum, and this is exactly what we always said, i.e. we use the situation also to improve our overall portfolio quality. And this is then also reflected in the achieved multiples. i.e. the lowest portfolio multiple, and this is the cross rent multiple, came in at 11, whereas the upper end is being marked by a multiplier of around 25 for our new build units, as we are also disposing on the high-end spectrum of our portfolio now. Those are coming from our new development pipeline, which is gradually running out. And after the projects have been completed, we rent them out and we sell them now institutions like pension funds, which are looking exactly for those type of ESG compliant products. We are confident that there is more to come in the coming quarters, which should help us to increase disposal volumes further and which should also help us to bring down our leverage. In terms of pricing, we stick to our price discipline and we sell at least at book value. For the 170 million euros, we could even get a small premium, which makes us also confident that we see a bottoming out of the market. And which brings me to my next point, the valuations. We expect valuations in 2024 to bottom out. We do valuations on a semi-annual basis, and for H1 2024, we expect another 1 to 3% devaluation. With this, deceleration of the devaluation continues, and for the second half, we expect a bottoming out. The last recent transactions from us, but also from peers, should provide some confidence that the bottom is near. And based on our valuation expectations, we should move towards a yield of 5% on a gross basis and towards 4% on a net basis. This would represent already an attractive spread over the 10-year bond. And based on our valuation assumptions, the disposals we already did, we expect the LTV level to keep at around 48% by year end. And before I come to the end of my presentation, let me just summarize on our key investment highlights. First, LEG is active and is leading in a market with a structural supply-demand imbalance. As the number 2 in Germany overall, the number 1 in our home turf in North Rhine-Westphalia, we are well positioned to capture the potential which comes from a supply which is coming down, especially as there is no supply coming in the affordable segment where we are active in. And on the other side, given as the population overall is growing, the demand for affordable housing is still growing. Secondly, with the crisis, we changed our business model towards cash generation. Cash is king. This is our slogan, and AFFO is our core KPI. AFFO has been already introduced since we have been IPO'd in 2013. So you have the historical numbers at our end, which makes it easy for you to track our cash generation. Thirdly, it's a resilient business model. We are fully rent out within our business. We have been proven being resilient during the Corona crisis, but also during the JFC. And the cash collection remains and remained high during those times of crisis. Currently, we are at a cash collection, i.e. the rent we get from the potential rent is more than 99%. Fourthly, we have structural growth drivers embedded within our business model. First of all, from a market perspective, we expect the market trends continue to grow and to expect the dynamic to increase further. Secondly, we have specific growth drivers from our subsidized units. 20% of our portfolio roughly is driven by subsidized units. They can be adjusted on a CPI basis each and every 3 years. We had the last CPI adjustment and the cost trend adjustment last year in 2023. Specific growth is coming in 2026. And there will be even a stronger growth driver in 2028 when roughly 15,000 units get off restriction and we can adjust those subsidized units towards the market rent level. Fifth, we are clearly leading in sustainability and we are a provider of decarbonization solutions. So we are top ranked by all the major ESG rating agency, be it MSCI or Sustainalytics. We just got the approval by the SBTi for our targets and our target initiative. We are on track for our climate neutrality path by 2045. And we offer own solutions for the decarbonization of the entire industry, as they do not only help us to decarbonize, but especially as we also believe that this is a significant market which opens third-party opportunities. I hope I gave you a good insight into our Q1 performance, but also into our investment case. Please do not hesitate and contact the LEG IR team in case you want to dig deeper into the LEG story. Many thanks and have a good day.